Hi, I am Daniel Paul D'Souza, and I would like to begin this presentation with a quote from one of my favorite books. So, why am I doing this? This whole presentation, what's the point of it? The reason I'm doing this is to find my treasure. And when I say treasure, I don't mean just something monetary. It is to find my life's journey and destination. And I'm sure that my treasure lies here, because my heart lies here. So, how am I doing it? How am I going about finding my treasure? I have studied numerous assets over the last few months and have identified negatively correlated assets. I'm structuring trades around these assets with explosive risk reward scenarios using derivatives. And what do I do? Simply put, I help investors reduce their drawdown during market stresses. And I will explain as we move forward in this presentation as to why reducing or protecting drawdowns is more important than having higher returns. So this pyramid, it explains what I do, how I do it, and why I do it. And my why is the basis of everything I'm doing. So let's move forward by understanding how declines work. The first column has a starting value of 100, and every row shows various declines in percentages. The next columns shows that after a certain decline, if one wishes to get back to the starting value of 100, then what are the percentage gains required? For example, if the starting value of 100 were to decline by 40% to a value of 60, then you would require a return of 67% just to get back to the starting value of 100. And if the starting value of 100 were to decline by 90% to a value of 10, then you would require a return of 900% just to get back to the starting value of 100. So a very important concept to understand is that a decline of 50% and a gain of 50% aren't the same in terms of absolute value. In order to avoid such kind of declines or drawdowns, what many investors or their advisors or managers do is that they diversify their holding, you know. So let's have a look at how well this kind of diversification that usually the advisors and managers do, like, how well did this diversification work for a portfolio in the great financial crash of 2008 and in the COVID crash of 2020. Here are charts for various asset classes for the period 2007 to 2009. Turns out diversification didn't help much in 2008. This is your S&P index, this is your government bonds, these are your high yield bonds, these are your commodities, your private equity, and your real estate. None of them were spared. And if you look at the same assets during the 2020 crash, the results are the same. Your S&P index, your government bonds, your high yield bonds, your commodities, your private equity, your real estate. No outright benefit of diversification here too. But you know what? When everything was going down, 50, 60, 70%, there was something that shot up 4 to 5 times. Something that is dancing to the beat of their own drum. This negatively correlated asset, or rather index, was the VIX. As you can see here, during the GFC, when the S&P was down almost 57%, the VIX index was up almost 450%. And during the COVID crash, when the S&P was down 35%, the VIX index was up almost 550%. In fact, if a portfolio had allocated anywhere between 1 to 2% to VIX calls during this period, that portfolio could have avoided a drawdown completely because the gains on the calls would have offset the drawdown on the portfolio. assuming that the portfolio was only S&P 500. These are the returns on VIX calls during the 2008 and the 2020 crash. As you can see, during 2008, 25% out of the money VIX calls had a return of approximately 39 times. And during the 2020 crash, 40% out of the money VIX calls had a return of approximately 64 times. So now the question arises: isn't everyone already doing it? I mean, everything that I've explained so far is pretty clear, right? And if it is so clear, and if people are not doing it, then why aren't they doing it? Well, in my opinion, there are two reasons for people not doing it. The first is that they cannot predict when the VIX is going to explode to provide a 30, 40, or maybe 100 times returns on their calls. And I think this is the most important reason. And the second reason is that because one cannot predict the VIX explosion, and because it cannot be predicted, they keep on buying VIX calls, assuming that it can, explode in any given week or a month. It will just lead to the portfolio underperforming because of the cash outflow from continuously buying VIX calls. Okay, so you have understood everything I had to say till now. Then the question arises as to what do I have to offer? So what I'm able to offer is a way to time the VIX explosion and a way to construct a trade that can offer explosive returns. What you see here is a model that is capable to predict the VIX explosion within the next 6 months after a set of two rules have been satisfied. There are two charts here. The left chart will project the indicators that will satisfy the rules, and the right chart is the S&P 500. Also note in the second chart on the right, the blue shaded area shows the change in percentage of the S&P 500 index from a given date and is indicated by the primary axis, which is on the left. The orange line shows the S&P 500 index and is indicated by the secondary axis on the right. Now let's observe the years 1988 to 1990. This is the period when the first VIX explosion occurred. We start from this period because VIX began to be calculated in January 1990. The green line that you see on the left chart is line 1. Line 2 is the blue line. The first rule is satisfied when the blue line, which is line 2, is higher than the green line, which is line 1. And this happened in December 1988, as can be seen here on the chart. The second rule is satisfied when the black line, which is line number 3, is lower than the blue and the green lines. Remember that rule number 2 has to be satisfied only after rule number 1 has been satisfied, which is the blue line has moved higher than the green line, which happened here in December 1988. The second rule was satisfied in February 1990, as can be seen here on the chart. As I had mentioned earlier, the indicators work to predict a VIX explosion within the next 6 months when the two rules are satisfied. And as it can be seen on the chart, that both the rules have been satisfied. We have a VIX explosion in August 1990. The orange line is the VIX. On the right hand side chart, which displays the S&P 500 index and the change in percentage on the S&P 500 index, you can clearly see the effect of the VIX explosion on the index in percentage terms. A further analysis of the events leading up to the VIX explosion and the appropriate time to initiate a position can be read here. Now, my indicators say that whenever rule number 1 and rule number 2 are satisfied, a VIX explosion occurs within the next 6 months. And this has happened in all the VIX explosions of 1990, which is the one we are seeing now, in the VIX explosion of 1998, 2001, 2002, 2008, and 2020. Let us just not agree to my statement being true. Let us verify it by looking at the events that occurred before the rest of the VIX explosions. Now let's move on to observe the year 1998. The first rule is satisfied when the blue line, which is line number 2, is higher than the green line, which is line number 1. And this happened somewhere in May 1998. And this can be seen here on the chart. The second rule is satisfied when the black line, which is line number 3, is lower than the blue and green lines after rule number 1 has been satisfied. The second rule was satisfied somewhere in June 1998, as can be seen here on the chart. As the two rules have been satisfied, we have a VIX explosion in August 1998. On the right hand side chart, you can see the effect of the VIX explosion on the index in percentage terms. A further analysis of the events leading up to the VIX explosion and the appropriate time to initiate a position can be read here. Now let's move on to observing the years 2000 to 2002. The first rule is satisfied when the blue line is higher than the green line. This happened somewhere in February 2000, and that can be seen on the chart. The second rule is satisfied when the black line is lower than the blue and green lines. The second rule was satisfied somewhere in May 2001, as can be seen here on the chart. As the two rules have been satisfied, we have a VIX explosion in September 2001. Now, with regards to this time period of 2000 to 2002, I would like to say that this period is an exception because there are two VIX explosions occurring here. One happened in September 2001 and the other happened in July 2002. Although the first VIX explosion occurs within the time frame of 6 months after the two rules have been satisfied, one should keep in mind that this happened because of 9/11. Moving on, the right hand side chart shows you the effect of the VIX explosion on the index in percentage terms. A further analysis of the events leading up to the VIX explosion and the appropriate time to initiate a position can be read here. Also note that the analysis here is done with regards to the second VIX explosion of July 2002 and not the first VIX explosion of September 2001 for the period 2000 to 2002. Now let's move on to observing the years 2005 to 2008. The first rule is satisfied when the blue line is higher than the green line, and this happened somewhere in December 2005. The second rule is satisfied when the black line is lower than the blue and green lines. The second rule is satisfied somewhere in April 2008, as can be seen here on the chart. As the two rules have been satisfied, we have a VIX explosion in October 2008. On the right hand side chart, you can see the effect of the VIX explosion on the index in percentage terms. A further analysis of the events leading up to the VIX explosion and the appropriate time to initiate a position can be read here. Now, let's move on to observing the period of 2019 to 2020. The first rule is satisfied when the blue line is higher than the green line. This happened in August 2019, as can be seen here on the chart. The second rule is satisfied when the black line is lower than the blue and green lines. The second rule was satisfied somewhere in November 2019, as can be seen here on the chart. As the two rules have been satisfied, we have a VIX explosion in March 2020. On the right hand side chart, you can see the effect of the VIX explosion on the index in percentage terms. A further analysis of the events leading up to the VIX explosion and the appropriate time to initiate a position can be read here. With this, I've shown you how my model can predict a VIX explosion within the next 6 months. Moving on, I would like to show you something interesting here, which is the basis of my belief that reducing or protecting drawdowns is more important than having higher returns with higher drawdowns. Here are 6 charts. The top 3 charts show the last 3 crashes, which are the dot-com crash, the GFC, and the COVID crash. The bottom 3 charts show the run-ups that have happened after a crash up to the next crash. Just to quickly run through them, during the dot-com crash, the market was down about 50%, followed by a run-up of about 100% all the way up to the GFC. The GFC brought the market down by about 57%, which was followed by a run-up of about 410% up to the COVID crash. The COVID crash had a drawdown of 36%, followed by a run-up of about 120% until the mid of June. So what's the point that I'm trying to make? Well, this table will help you understand the point that I'm trying to make. The first row shows the drawdowns in red and the run-ups in green, which were from the previous charts. The next row shows the value of a portfolio in these different periods, ending with a final value. Note that this row assumes that you have no hedge. The next rows show the value of a portfolio for the different periods with different levels of hedge, culminating in a final value. For example, let's say you have a portfolio with no hedge. Your starting value of your portfolio is 100, and you started this portfolio at the peak of the dot-com bubble. So there was a drawdown, your value is now 50. Then there was a run-up, your value is now 100, followed by a drawdown, followed by a run-up, followed by a drawdown, followed by a run-up, which brings your total or your final value as mid of June to about 310. So about 20 years ago, you started with 100, and now you end up with 310 with no hedge. Now let's assume you had a hedge which offsetted your drawdown by 20%. What does that mean? So let's say in this drawdown, you lost 50%, but because you had a hedge, that hedge had a return of 20%. That 20% will offset the 50%, and your net drawdown, the positive 20% rather, would offset the negative 50%, and your net negative drawdown would be minus 30%. And so would be the case for this, where the net negative drawdown would be minus 37%, and here it would be minus 16%. So coming back to this row, so if you had a hedge which offset your drawdown by 20%, you start with 100 at the peak of the dot-com bubble. It would have gone to 70, then 140, followed by 89, 454, 381, 835, which is your final value. So you would have started with 100, and after 22 years, you would have ended with 835. Notice that with only a 20% offset, where your drawdown was offset by 20% because of an effective hedge, your final portfolio value compared to a portfolio with no hedge is almost 2.5 times higher. Now, another example is, let's say you had a, a hedge which offsetted your drawdown by 60%, which literally means that during the periods of drawdowns, you actually made some money. You made some, yeah, you made a positive return. So you started with 100, went to 110, 222, 228, 1167, 1447, and your final value is 3170. Started with 100, after 22 years, you ended up with 3170, which, if you notice, is almost 10 times the final value of a portfolio with no hedge. So this is the power of reducing your drawdowns or protecting your drawdowns. So how can you reduce your drawdowns? Well, before we move on to me explaining to you how can you reduce your drawdowns, another one of my favorite quotes. This is to emphasize that a VIX explosion will definitely happen once again. So with my model that I had shown earlier, we are able to predict a VIX explosion within the next 6 months. And because we are able to predict when the VIX will rise exponentially, we have a defined period within which we can take positions in VIX calls. Here, I have a chart of the VIX futures term structure for certain periods of 2019 and 2020. VIX options are priced off the VIX futures and not the VIX index, and so understanding the term structure of VIX futures is essential. The VIX futures term structure is usually in contango, as can be seen by the blue line. But during market stresses, it usually moves in backwardation, as can be seen by the black line, which was during the COVID crash. The same contango and backwardation can be noticed here during the GFC. The blue line here is in contango and the black line here is in backwardation. By analyzing the VIX futures term structure, I have created a hypothetical position in VIX calls with a 2-month expiry and assuming that the IV or the implied volatility will increase by 150%. I have chosen the expiry date and assumed the increase in the implied volatility based on the changes in the VIX futures term structure observed during the GFC and the COVID crash. As can be seen here, there is a possibility of making a 300 times return. Again, I have created a hypothetical position in VIX calls with a 2-month expiry and assuming that the IV will increase by 150%. The construction of this trade is based upon my model, which predicts a VIX explosion within the next 6 months, and the analysis of the VIX futures term structure. Now a trade here has a 2-month expiry, but the increase in volatility could happen anytime in the next 6 months, and hence one of the ways to optimize the trade to take advantage of the term structure and the increase in volatility is to divide the total risk into multiple tranches. The ideal number of tranches required would be 5 because that would cover you for 6 months. If you see here, 5 tranches, they cover you for 180 days, that is 6 months. Once a tranche has been initiated, this first tranche, the 4 highlighted cells, one cell is 15 days. So once a tranche has been initiated, the next tranche would be initiated after 30 days. And we will not wait for the previous tranche to expire. For example, you want to risk only 2% of your portfolio. So you divide that into 0.4% each for every trade. If you want to risk 5%, then that would be 5 tranches of 1%, and so on. Also note that all these trades are debit trades, that is, there will be a cash outflow from a portfolio. But what if one It didn't want a cash outflow from the portfolio and still wanted to take these trades. Well, there's a way to do that too. One can make a trade cash flow neutral by taking a credit trade, which is a cash inflow, and using that credit to take a debit trade, which is a cash outflow, thereby making the cash flow neutral. You can make a credit trade on SPX, which are out of the money by at least 5% and up to 8%, and use the credit to take the debit trade on the VIX calls. Why would I recommend credit trades on SPX and that too 5% to 8% out of the money? It is because after the black line, which was line 3 of my model, moves lower than the blue and green lines, from that point and all the way up to the VIX explosion, the S&P does not close beyond a positive 5% on a monthly basis. And that is the case for all the VIX explosion periods. You can see the different VIX explosion periods here. That is the period between the black line going lower than the blue and green lines and the VIX explosion. As you will see here, during the 1990 VIX explosion, there was not a single month where the SPX or the S&P index moved over 5%. Same goes for the 1998 VIX explosion, same for the 2001-2002 VIX explosion period. The same goes for the great financial crash and the cold crash VIX explosions. So, to summarize of what I have to offer, I offer a model to time the VIX explosion. I offer a derivative positioning strategy for high risk reward. And I offer a position deployment strategy at zero cash outflow to the portfolio. So that was all with my presentation. These are my contact details. Thank you for your time.